The hidden order of indicators. Most traders get this wrong. In fact, I've seen very, very few traders in my career that ever really understood this concept. Certain aspects of it, there are thousands of traders that are pros, that are experts in different aspects of what we're going to talk about today, but not in putting it all together, not understanding how it all links. We start with this hierarchy because when we understand this hierarchy, then everything else makes sense. When I introduce it to traders, a lot of them will look at it and go, oh, this is great. So let's get into it. I'm Chuck Whitman, and I build great traders that lead great lives. Traders I've trained have generated in excess of $1 billion in trading revenue and are found in some of the biggest proprietary trading firms and hedge funds in the United States. There are 6 components that are involved in trading, and there's a hierarchy of indicators. There's a hierarchy of how these components link together and how these components flow together. We'll notice that on the left is the hierarchy, and there's 2 types of leading indicators, only 2, which are order flow and volume above the dotted line, and below the dotted line we have the lagging indicators. We have volatility, we're going to have to wait for the next one. We have to wait to the end, and then we have trend, and we have overbought and oversold. On the right, I want you to notice we have the primary focus of a professional trader. Professional traders focus on order flow, volume, and volatility. Retail traders focus on concept 4, which we'll come back to. They focus on trend, and they focus on overbought and oversold indicators. So they learn indicator packages. There are thousands of them out there for sale that tell you that they can predict the market. They don't really predict the market. They really identify the market in hindsight. Now, there is some use for these. There's some really good uses for these, actually, but we have to understand the proper context in which to use them. That's another thing that most traders have no idea of the proper context of how to use lagging indicators. But as we said, pros focus on order flow and volume. So let's get into that. Order flow is the first sign of any activity in the market. It's the first time we can actually observe something going on. And this is when a bid or an offer comes into the market. It can come into the order book. We'll see a bid off the market or an offer off the market when the quantities change or a quantity introduces itself. And over the counter, it will be done via direct messaging, via chat, via phone. A bid will start to be introduced, an offer will start to be introduced. Now, people look at order flow and say that order flow can be interpreted to influence the market. So quite simply, if there's an imbalance of bids, there's a lot of bids coming into the market, the conclusion is the market's strong and we want to be buying. There's maybe an assumption that if we break, those bids will be there, or these bids might turn to market orders and bid it up. So order flow, I want you to think about this. Proprietary trading firms and banks pay millions, even billions of dollars for order flow. And in so many cases, where you'll see somebody look at a bank trader or a prop trader and go, that guy's so smart. He's always making money. He's never wrong. Well, he's got order flow. If he has order flow, he's massively put the odds in his favor. That's why they pay for it. They pay for it because there's so many things they can do to use it. The thing about order flow, though, is it can be gamed. It can be manipulated. It's a little bit like playing Texas Hold'em in poker. You can try and manipulate the pot through bluffing. And people do the same thing with order flow. They try and bluff the market. So there's this concept of spoofing, which now in some places is illegal, in which you can place a large order into the market, put a large bid into the market to get everybody excited that there's a big buyer, and then they'll come by ahead of you. When they do, you sell it to them. This is how you liquidate your long. This has been a famous thing for years. I'm long a bunch of contracts. I want to get out. What do? I start putting big bids into the market to scare people into buying it up. Then when they buy it up, I sell it to them. So that's spoofing. So we have to understand that order flow is the most leading indicator. By far, it is the most leading. It has incredible value, but it can be manipulated and sometimes it can be somewhat opaque. This moves us to volume. Volume is the first confirmed activity in the market. When we see a bid and offer, we don't know if that's real or not. But once it trades, we know it's real. So volume is confirmed activity. And transacted volume either creates impact or no impact. We're really big on this concept of impactful volume. Impactful volume is volume that is big enough to destabilize the market. So you'll hear this saying that 80% of the time markets go nowhere. They're in congestion. Well, if we were to look at that at its base, what it's essentially saying is the market has a fair value and prices just oscillate around fair value. If they get too high, sellers come in to sell it down. Buyers don't want to buy it because they're paying too much, and the orders thin out and price reverts back to the mean. If it gets too low, the buyers start to show up knowing they're buying it cheap, and sellers know they're selling it too cheap and they won't sell it, and the price comes back. So 80% of the time, the market is rotating around fair value, but it shifts when impactful volume comes into the market. We like to talk about it takes force to change value. So transacted volume either creates impact or no impact. Volume can be tracked to know the specific prices and the specific number of shares or contracts that are traded. So we can go to time and sales and we know how much is trading at what price. There's also software packages that tell us that very thing, how much is trading at what price. This allows us to be able to track the activity of large buyers and large sellers, and that is useful for us in making our trading decisions. So order flow and volume are the only two leading indicators we have. Both lead the market by influencing in the case of flow or impacting in the case of volume. Other indicators react to this activity and are lagging. So now that we know this, now we can start to go below the line and look at the lagging indicators. The lagging indicators, we have volatility. When we talked about impactful volume destabilizes the market and causes volatility. Impactful up volume causes sellers to remove their sell orders and shorts to force to exit, to liquidate. This leads to range expansion. Range expansion is another way of saying volatility. Volatility, if you go back to the first slide, one of the things you'll notice is that the line was below volatility. And this is because most retail traders do not understand volatility at all. They get it a little bit, and they'll use a Bollinger Band. A Bollinger Band is their expression of volatility. And Bollinger Bands have their utility. We use them in some cases. But man, that is like volatility for kindergartners. Professional traders really understand the impact of volatility, and there's all kinds of things that can be done when volatility is high or when volatility is low. Then we move to trend. Well, we skipped it. Remember 4? I skipped it. So I'll come back to 4. So trend is number 5. Trend is when we have momentum cycles that persist. In other words, we get several momentum cycles. A long-lasting trend will have waves of impactful volume that start to cycle all over again. Every time we get impactful volume, we get the start of a new wave. Impactful volume, start a new wave. Impactful volume, start a new wave. Then impactful volume comes in, they buy, and then they're done and it recedes. And then they come in again, they buy, and then they're done and it recedes. This will continue over and over throughout a trend as the market moves higher. So trend is a series of these, not just one. And then trend, this eventually leads us into markets that are overbought or oversold. Markets that become too extreme lead to the markets being stretched. I like to use this red rubber band. This is a normal market, but when the market starts to gain volatility and gain momentum, it gets stretched, it gets more and more stretched. And now it's too stretched. It's unsustainable. It either has to snap back or it has to break. So anytime volatility or momentum gets too stretched, they're open up to reversion and popping back. Trends that persist too long become overbought and oversold. Overbought and oversold conditions get worked off by reverting to the mean. And then we talk about there's 2 ways that we revert to the mean. One is the way most people think about is where the price reverts back to the mean. In other words, buyers get trapped and there's a rapid sell-off that takes the market back to the mean. The second way is the way people don't really think about, which is that the market can move sideways while the mean catches up. So reversion can be played not only by going back to the mean, but by waiting for the mean to catch up. Let's go to number 4, the one you've been waiting for. Number 4 is momentum. All right, let's talk about momentum. A lot of people trade momentum. A lot of people have momentum indicators, things like MACD or stochastics. All right, so volatility that persists. Volatility that persists leads to momentum. You can think of it another way. Volatility that follows through leads to momentum. Impactful volume causes the market to continue to rally, which forces additional short covering and brings in momentum buyers. Same thing on the short side. Impactful volume causes the market to break, which forces additional puking or covering, which brings in momentum selling. And this is what we've seen a lot of in the last month, where really strong names over the last 6 months got just clobbered in February and March. So here we go back to the 6 components of trading, and you can see that momentum sits number 4. So we have an order that shows up in the market via order flow. It transacts, creating volume. And if it's big enough, it creates volatility in the market. And that volatility translates to momentum if it keeps going in one direction. And then if we get multiple momentum cycles, we'll create a trend. And if volatility goes too far, momentum goes too far, or the trend lasts too long, we create overbought, oversold conditions. in which the market has to revert to the mean to work off the overbought, oversold. So for you, when you look at your trading, look at how you trade. Which of these do you have? So each of these categories has different indicators. Which ones do you have and why do you use them? Where are they in the hierarchy? I see a lot of people use a MACD, a stochastic crossover, and they use this essentially to time up their entries and to identify trends and overbought, oversold. And then they're getting picked off. They're late with these sort of things. Well, they don't have the context. They don't have volatility, first of all, but going up above the line, they don't have volume and they don't have order flow. If we have a huge buyer, if a central bank is buying and they're buying big, they do not give a shit what your MACD or stochastic says. They don't. But we can see their volume and we can trade ahead of them and we can get with them. So what day is it? That's right. It's Tuesday. And it's not just any Tuesday. No, it's Trader Tip Tuesday, where I come to you with tips and tricks like today with the hierarchy of indicators to help you take your performance to an elite level. I will see you next Tuesday.